What if the biggest signal for gold right now is not inflation, not the Federal Reserve, and not even the next interest rate decision? What if the real signal is something much deeper, a change in the way investors and central banks view the financial system itself? Because that is the question sitting underneath one of the most interesting gold arguments in the market right now. For decades, investors were taught a relatively simple rule. When real interest rates rise, gold becomes less attractive. Why? Because gold doesn't pay interest. So if government bonds begin offering a higher inflation-adjusted return, investors have a stronger reason to move money away from gold and toward yield-producing assets. That relationship became one of the most important frameworks for understanding gold. But according to the thesis presented in the source material, something unusual has been happening. Gold has shown resilience even while the traditional interest rate relationship has not behaved the way investors would normally expect. The speaker describes this as a possible structural decoupling, essentially the idea that gold is being supported by forces that go beyond the traditional real rate trade. And if that interpretation is correct, then we may be looking at a much bigger story than another short-term gold rally, because the real question is no longer simply, will the Fed cut rates? The bigger question is, what happens when investors start demanding an asset that does not depend on someone else's promise to pay? That brings us directly to the most important part of this entire argument. Gold has no corporate balance sheet behind it. It doesn't require a government to remain solvent. It doesn't require a company to generate earnings. And unlike a bond, it does not carry a contractual promise from a borrower. That doesn't make gold risk-free. It doesn't mean the price can only go higher. Gold can still experience sharp corrections, especially when the dollar strengthens, liquidity tightens, or real yields rise. But the reason investors may own gold can change, and that is where this thesis becomes much more interesting. The source connects the gold story to a much broader financial system question: debt, confidence in sovereign assets, central bank reserve behavior, and the growing concern that traditional markets may be carrying risks that are not immediately visible on the surface. This is important because markets don't always wait for a crisis before they start repricing risk. Sometimes the repricing begins quietly. A central bank adds gold instead of another unit of reserve currency. An investor reduces exposure to long-duration government debt. A portfolio manager increases allocations to assets with no direct counterparty. A country diversifies its reserves. Individually, none of these actions necessarily means the dollar system is collapsing. But collectively, they can tell us something about confidence. And this is where I believe the gold debate needs to become more sophisticated. The bullish argument isn't simply that the world is printing money, therefore gold goes up. That's too easy. The more important question is whether the global financial system is gradually becoming more fragmented and whether gold is becoming more valuable as a neutral reserve asset in that environment. The source material also points toward central bank accumulation and China's demand as part of this structural story. Now, we have to be careful here. A strong gold thesis does not mean every bullish claim circulating online is automatically correct. Some of the more dramatic figures in the presentation, particularly around AI-related debt and credit market stress, need independent verification before they should be treated as established facts. But we don't need every dramatic claim to be true for the larger question to remain important, because there is already a fundamental issue staring directly at the market. If investors become less comfortable relying exclusively on traditional financial assets, where does that capital go? Some of it goes into cash, some goes into short-term government securities, some goes into commodities, and some goes into gold. That is why I don't think the most interesting gold story right now is simply about whether gold can break another technical level. The more important story is whether the market is slowly changing the way it values gold itself. For years, gold was often treated primarily as a hedge against inflation or falling interest rates. But what happens if gold increasingly becomes a hedge against financial system uncertainty? That is a completely different investment narrative. And it also explains why gold can sometimes remain strong even when one traditional indicator is telling investors that it shouldn't. The market may be pricing something that the traditional model does not fully capture. And if that is happening, then the next gold move may not be determined by one Fed meeting. It could be determined by something much bigger: confidence. Because once confidence in the traditional system begins to weaken, the question isn't simply where interest rates are going. The question becomes what investors want to own when the promises behind those financial assets become less certain. And that is exactly where this gold story gets much more serious. Now, here is where the gold story becomes even more interesting, because gold is not moving in isolation. There is another market sitting in the background that could become extremely important for precious metals, and that is the credit market. The source material makes a very aggressive argument about the current AI investment boom. It points toward enormous capital spending by major technology companies and argues that some of this investment is increasingly connected to debt and financing structures outside the simple headline numbers investors see in quarterly earnings. The presentation even puts a potential figure of around $3 trillion on broader AI-related obligations. That number needs independent verification, so I would not treat it as an established fact. But the underlying question is absolutely worth investigating. How much leverage is being built into the next phase of the AI boom? Because this is where the gold connection begins. Imagine an economy where companies are spending enormous amounts of capital because investors believe future AI revenues will justify today's valuations. As long as revenue expectations continue rising, the system can look incredibly strong. Technology companies spend money. That spending becomes revenue for other companies. Those companies then invest again. Investors see stronger revenues. Stock prices rise, credit remains available, and the cycle continues. But there is a problem with every financial boom built around increasingly optimistic expectations. Eventually, the market has to ask whether the cash flows are strong enough to justify the amount of capital being deployed. And when that question moves from the stock market into the bond market, the consequences can become much larger. This is why the source spends so much time talking about Oracle and credit default swaps. The argument is that credit markets can sometimes identify financial stress before the broader stock market acknowledges it. A credit default swap is essentially a market-based way of pricing protection against a borrower failing to meet its obligations. When investors become more worried about credit risk, that protection becomes more expensive. And that gives us a very important macro signal. Stocks can continue looking optimistic, while credit investors become increasingly cautious. And historically, those disagreements deserve attention, because the stock market is primarily asking, how much could this company be worth? The bond market is asking a different question. Will I actually get my money back? Those are not the same question. And when the two markets begin telling different stories, the bond market can become extremely important for gold. Why? Because a deterioration in credit conditions can eventually affect liquidity, risk appetite, government borrowing costs, and expectations for monetary policy. And that brings us back to the Federal Reserve. If financial stress suddenly increases, the Fed may eventually have to respond. That could mean lower rates, more liquidity, or a shift away from restrictive policy. And historically, expectations for easier monetary policy can become a major tailwind for gold. But there is an even more interesting possibility. What if the Fed is forced to respond at a time when government debt is already extremely high? Then the market has to think about something much more uncomfortable. How much more debt can the system absorb? And if investors begin questioning the long-term sustainability of government borrowing, gold becomes more than an inflation hedge. It becomes a hedge against monetary and sovereign risk. That distinction is critical. Because when people say gold rises because the Fed cuts rates, they're describing only one part of the mechanism. The deeper mechanism could be that investors expect monetary policy to become easier because the financial system itself is becoming more fragile. In that environment, gold can benefit from a combination of falling real yields, weaker confidence in financial assets, reserve diversification, and increased demand for an asset with no direct counterparty. That is a much more powerful setup. But there is a catch. The path from financial stress to higher gold prices is not necessarily straight. In the initial stage of a major market shock, investors often sell whatever they can sell to raise cash. Gold can fall during that first phase. That sounds contradictory, but it is one of the most important things to understand about crisis markets. Gold can be a safe haven asset and still decline temporarily during a liquidity event. Why? Because investors don't always sell gold because they dislike gold. Sometimes they sell gold because they need dollars. And when everyone suddenly wants dollars at the same time, the dollar can strengthen dramatically. That can create short-term pressure on gold, even while the long-term reason for owning gold becomes stronger. This is exactly why the source's panic to shakeout to structural accumulation framework deserves attention. The first stage is fear. The second stage is the shakeout. The third stage is where stronger institutional demand can begin to dominate. And the fourth stage is the possibility of new highs. I'm not saying that this sequence is guaranteed to repeat in 2026. Markets don't operate according to a perfect four-step formula, but it gives us a useful framework for interpreting price action. And here's the part that matters most for gold investors. If credit stress increases while the dollar initially strengthens, gold could experience another period of volatility. But if that stress eventually forces markets to price easier monetary policy, falling real yields, greater fiscal concerns, and increased demand for reserve diversification, the same crisis that initially hurts gold could eventually become one of its strongest catalysts. That is the paradox. The first reaction to a financial crisis can be bearish for gold. The second reaction can be extremely bullish, and this is why I would not analyze gold simply by looking at today's price. I would watch the interaction between gold, real yields, the dollar, credit spreads, treasury markets, and central bank demand, because those markets together can tell us whether a gold move is simply speculative or whether something structural is developing underneath it. And there is another factor we cannot ignore: central banks. Because while private investors debate whether gold is too expensive, central banks have a completely different objective. They aren't necessarily trying to beat the market over the next 3 weeks. They're thinking about reserves, liquidity, geopolitical risk, sanctions, currency diversification, and the reliability of the financial system over many years. That is why central bank gold accumulation could become one of the most important long-term variables in this entire story. And if that demand remains strong while new mine supply takes many years to develop, the market could face a very different supply-demand equation. Which brings us to the question I think matters most now. What happens when the traditional financial system starts losing some of its appeal at exactly the same time that central banks are increasing their demand for a monetary asset that exists outside the liabilities of another country? That is where gold stops being just a commodity. It starts becoming part of the architecture of the global monetary system, and if that transition is actually underway, then the next gold rally could be driven by something far more powerful than the next inflation print. And this brings us to perhaps the most important piece of the entire gold equation: central banks. Because there is a major difference between a short-term investor buying gold because they think the price is going higher and a central bank buying gold because it wants to change the composition of its reserves. The first is a trade, the second can be a structural decision, and that distinction matters enormously. For decades, the international financial system was built around a relatively simple hierarchy. The dollar was the dominant reserve currency. U.S. Treasury securities were considered one of the primary safe assets, and central banks around the world could hold large amounts of dollar-denominated assets as part of their reserves. That system still exists. But the question is whether it is becoming less dominant at the margin. The source material argues that geopolitical tensions, sanctions, reserve diversification, and concerns about relying too heavily on another country's financial system are encouraging governments to reconsider how their reserves are allocated, and this is where gold has a unique advantage. Gold does not belong to another country's central bank. It does not depend on a government continuing to honor a debt contract. It does not require a payment network to remain available, and it cannot be created with a keyboard. That doesn't mean gold is automatically superior to every financial asset. It means gold has a different risk profile. And when geopolitical uncertainty increases, that difference becomes more valuable. Think about the decision from the perspective of a central bank. If you hold another country's government bonds, you are holding an asset that ultimately depends on another country's financial and political system. If you hold gold, you still have price risk, but you remove much of the direct counterparty risk. That distinction becomes especially important in an era where financial sanctions and reserve restrictions have become part of geopolitical policy. The source makes this point very strongly. Gold can function as a reserve asset that exists outside another country's liabilities, and that helps explain why central bank buying deserves far more attention than it sometimes receives. Because central banks aren't necessarily trying to predict next month's gold price. They're thinking about the next decade. That means their buying behavior can create a different kind of demand. It is less sensitive to short-term technical patterns, less sensitive to whether gold is overbought on a daily chart, and potentially more persistent. Now, China is an especially important part of this discussion. The source claims that China's gold imports have reached extremely large levels relative to global mine production. That specific comparison should be independently verified before we use it as a hard statistic. But the broader question is much more important than one number. Why would one of the world's largest economies want to maintain or increase exposure to gold? There are several possible explanations. Reserve diversification is one, domestic investment demand is another, currency considerations matter, geopolitical risk matters. And then there is the possibility that countries simply want greater control over their own reserve assets. If several large economies simultaneously increase their demand for gold, the effect is different from a normal speculative rally. Speculators can leave. Central banks generally don't trade their reserves with the same short-term mindset. And this creates a potential floor underneath the market, not a guaranteed floor, but a structural source of demand. Now let's connect that to the dollar. A lot of people hear the phrase de-dollarization and immediately think the dollar is about to collapse. That is not what we need to assume. The dollar can remain the world's dominant reserve currency while its share of global reserves gradually declines. Those two things can happen at the same time. And that distinction is extremely important. The real story may not be the end of the dollar. It may be the end of the dollar's monopoly over reserve diversification. If central banks previously thought, why do I need gold? I can simply hold more dollars and treasury securities. And now they increasingly think, maybe I should hold dollars, treasuries, gold, and other reserve assets. then gold doesn't need to replace the dollar to benefit. It simply needs to become a larger part of the global reserve system. That is a much more realistic thesis, and it is potentially much more powerful because it does not require a collapse scenario. It only requires gradual diversification. This is why I think the phrase gold is a hedge against inflation is becoming too narrow. Gold can hedge inflation, but it can also hedge monetary uncertainty. It can hedge geopolitical uncertainty. It can hedge currency diversification, and it can hedge concerns about sovereign and financial system risk. That is a much broader demand base. But now we need to look at the other side of the equation, supply. Because if demand rises rapidly, the market eventually asks a simple question: where does the additional gold come from? And this is where physical gold is very different from many financial assets. You cannot simply increase production overnight. A new mine requires exploration, permitting, financing, construction, infrastructure, labor, energy, and years of development. The source puts the timeline for bringing a new mine online at roughly 10 to 15 years. The exact timeline varies enormously by project, jurisdiction, and deposit, so we should treat that figure as a broad industry claim rather than a fixed rule. But the underlying principle is correct. Gold supply is not infinitely flexible in the short term. That matters because financial demand can change much faster than physical supply. Central banks can decide to increase purchases today. Institutional investors can increase allocations this quarter. Geopolitical tensions can change in a matter of weeks. But a major new mine cannot respond to those changes immediately. And that creates an interesting structural imbalance. If demand remains elevated while supply responds slowly, the market has to adjust through price. That does not mean gold must rise every week. It means sustained demand can create upward pressure over longer periods. And this is where the entire thesis starts coming together. On one side, we have a financial system dealing with enormous debt burdens. On another side, we have a technology investment boom that is raising questions about leverage and future cash flows. We have governments managing increasingly complicated fiscal positions. We have geopolitical fragmentation. We have central banks considering reserve diversification. And we have physical gold supply that cannot quickly respond to a sudden increase in demand. None of these factors alone guarantees a gold bull market, but together they create a very different environment from the one investors became accustomed to over the previous decades. And there is one more factor we haven't fully addressed. The most important buyer in the market doesn't necessarily need gold to outperform stocks next month. Central banks don't have to believe that gold is going to double. They simply need to believe that having some gold makes their reserves more resilient. That is a much lower hurdle. And that may be one reason the gold market can remain structurally supported even during periods when speculative investors become frustrated. The short-term trader asks, why isn't gold moving? The central bank asks, do we have enough reserve diversification? Those are completely different questions. And if the second question becomes more important over the next several years, then the gold market may be entering a new phase. But there is still a major problem. Even if the long-term fundamentals are strong, gold can experience violent corrections. And that is where investors often make their biggest mistake. They confuse a correction with the end of a structural trend. The source's four-phase model, panic, shakeout, structural accumulation, and eventual new highs, attempts to explain exactly that behavior. The real challenge is identifying which phase we're actually in, because if the market is in a genuine structural accumulation phase, selling simply because price becomes boring could mean missing the next major move. But if the fundamental thesis is wrong, blindly holding through every decline can be equally dangerous. So the job of an analyst is not to promise that gold will go higher. The job is to identify which evidence would confirm the thesis and which evidence would invalidate it. And that takes us directly to the final piece of the puzzle. What happens if real yields remain high? What happens if the dollar strengthens? What happens if central bank buying slows? And perhaps most importantly, what happens to silver if gold continues to receive this structural monetary demand? Because silver is not simply a cheaper version of gold. It has its own industrial cycle, its own supply constraints, and its own relationship with global economic growth. And if the gold thesis is correct, silver could become the more volatile and potentially more complicated expression of the same monetary shift. That is where this story gets even more interesting. Now we arrive at the part that matters most for anyone trying to understand where gold goes from here, because having a bullish long-term thesis is easy. The difficult part is knowing what could actually make that thesis fail. And this is where I want to separate the emotional gold story from the analytical one. The emotional story says debt is rising, governments are spending too much, geopolitical tensions are increasing, central banks are buying gold, and therefore gold must go higher. But markets don't work that way. Markets can remain irrational for longer than investors expect. Gold can have strong fundamentals and still fall. It can have weak short-term momentum and still remain structurally bullish. And that means the next move in gold depends on the interaction between several variables, not one headline. The first variable I would watch is real interest rates. If real yields continue moving significantly higher, gold faces a genuine headwind. That old relationship may have weakened, but it has not necessarily disappeared. This is an important distinction. The source describes the relationship between real rates and gold as having experienced a structural break. But a structural break does not mean economic relationships become meaningless. It means the relationship may no longer explain the entire market. And that changes how we should interpret real yields. Instead of saying, real yields are rising, therefore gold must fall. The better question is, why are real yields rising, and what else is happening at the same time? If real yields rise because economic growth is strong, inflation is controlled, fiscal credibility is high, and investors are confident in government debt, that environment could be difficult for gold. But if real yields rise because inflation risk is increasing, government borrowing requirements are expanding, or the bond market is demanding more compensation for holding sovereign debt, the signal becomes much more complicated. The same number can have completely different meanings depending on the reason behind it. That is why context matters. The second variable is the US dollar. Gold is priced globally in dollars, so a stronger dollar can create pressure on gold even when the underlying demand story remains intact. And this creates another potential trap. Imagine geopolitical tensions increase. Investors become nervous. They sell risky assets. They buy dollars. The dollar rises. Gold initially struggles. A headline then appears saying, "Gold fails to rally despite geopolitical uncertainty." That headline may be technically correct, but it can completely miss the bigger story, because the first phase of a crisis can produce dollar strength and liquidity demand. Only later can investors begin asking whether the crisis itself creates conditions for easier monetary policy, greater fiscal stress, or deeper reserve diversification. This is why the source describes a sequence beginning with panic and moving toward a shakeout before structural accumulation. Again, I would not treat that sequence as a law of markets, but as an analytical framework, it is useful because it reminds us that the first market reaction is not always the final market reaction. And that brings us to silver. If gold is increasingly being treated as a monetary and reserve asset, silver introduces another layer of complexity. Silver has a monetary identity, but it is also deeply connected to industrial demand. That means silver can respond to two different forces at the same time. The first is the precious metals cycle. The second is the global industrial cycle. If monetary demand strengthens while industrial demand remains healthy, silver can potentially benefit from both sides. But if the global economy weakens sharply, industrial demand can become a drag. This is why silver cannot simply be analyzed as gold with more upside. It has a different risk profile, and that difference could become extremely important if the macro environment changes. Suppose the economy slows, the Fed becomes more dovish, real yields decline, the dollar weakens, gold responds positively. Silver could potentially respond even more aggressively if investors simultaneously begin anticipating a recovery in industrial demand. But imagine the opposite. Growth collapses, industrial activity contracts, manufacturing demand weakens. Even if gold is supported by safe haven demand, silver could face a different battle because part of its valuation depends on the industrial economy. That is the reason I would separate the gold thesis from the silver thesis. Gold is increasingly being discussed as a monetary hedge. Silver is a hybrid. And hybrids can outperform dramatically in the right environment, but they can also become much more volatile when the economic cycle turns against them. Now let's return to gold. One of the most interesting arguments in the source is that investors should not confuse a quiet period with the end of a structural trend. The presentation describes gold as potentially moving through a shakeout phase before a stronger structural move. There is an important lesson here. Markets don't usually make their biggest moves when everyone is comfortable. They often make their biggest moves after investors have become exhausted, when the bullish narrative has become boring, when people stop paying attention, when headlines turn negative.